Hey everyone, let's talk about investments and specifically about how we can model uncertainty about investments. First, we'll talk about what the relevance of return distributions is to portfolio design and investing more broadly. We'll talk about how to simplify return distributions using event trees. We'll go through a few examples and then we'll move on to the key statistical concepts in talking about uncertainty, which is to say the really important characteristics of a distribution of a random variable, such as its mean, standard deviation, and critically for returns, correlation and covariance. So let's begin with return distributions and how we can represent them using event trees. So in general, if you think about what an investment manager seeks to do, is they want to maximize return, minimize risk, and match the level of risk with the risk tolerance of the client. And of course, given a certain level of risk, we probably want to get the client as much return as possible. In other words, at bottom, we probably want to maximize the return to risk ratio. But before we can actually do any of this, we have to quantify all of these ideas. How do we measure return? How do we measure risk? How do we measure this trade-off? And so in this set of lectures, we're going to develop this set of tools. Return distributions are really important in portfolio management and in investments in general, simply because without them, you can't really navigate through the process that an investment manager would follow. If you think about what one may begin with is through some way, either as we talked about, through top-down allocation or bottom-up selection, we will choose some assets to put in our portfolio. Now, given that, and probably as part of this selection decision, we really want to figure out the range of values these assets, payoffs, and returns can take on, and therefore we need to get a probability distribution of these returns, so there's that word. We can't really move beyond step 2 until we talk about probability distributions. Now, probability distributions, as you remember from statistics, are relatively messy things. They're a continuous function of some sort, or maybe not even continuous with jumps. So one common approach is to simplify it. And we'll talk about how to do this with event trees. Once we've done that, then we can actually figure out what our portfolio weights might be, and given these weights and a simplified version of a probability distribution, we can actually then move on to calculate some portfolio payoffs. And once we have those, then using the second part of this discussion, we can actually compare one portfolio to another in terms of its risk, return, and correlation or covariance. And given all that, then we can actually, once we know what our client or investor's risk tolerance is, we can make a recommendation to a portfolio. So you can see that a knowledge of these statistical concepts is really central to many of these steps. So let's actually get through them. The first thing that we need to understand is that really we do want to quantify the risk and return characteristics for each asset. And even if we go back to our simple single period holding period return formula from our fixed income discussion, we may not necessarily know what the future payoff of the asset will be. So if you think about P1, you could say that, well, if we know the yield, we know what the future price of a bond will be, or maybe we can infer an expected yield from the term structure. But that exactly means that really our expectation of the future price of the bond is perhaps known, but there's some uncertainty about that expectation. And if we're talking about an asset other than a bond, then the future payoff is actually much more difficult to pin down. And without that, of course, the whole holding period return formula becomes uncertain. So we need to figure out how we can actually characterize it, given that we may not know the future price of the asset, P1, and we may not know the either future value of its coupons or dividends, D1. So how do we deal with this uncertainty in asset returns? Well, as we often do in statistics, when we don't know something, we will actually assume it to be a random variable. And a random variable is some varying quantity that can be characterized using a probability distribution. In other words, some mapping of likelihood to outcome. So by assigning probabilities to certain outcomes of the underlying asset's payoff or return, we can then actually characterize them the way we would with a random variable, and then there are many more things that we can say about potential outcomes and the riskiness of those outcomes for this asset than if we don't do this. So how do we actually put this in practice? Well, let's say that we're looking at a stock. We're looking at IBM. So a lot of things are unknown, right? With a stock, we may not know the cash flows it generates. We still, of course, as with a bond, don't know the discount rate for those cash flows with certainty. So the price of IBM tomorrow is definitely not known. But there's some things that we can probably say about it. If we know the price of IBM today, and for the sake of argument, let's say that it's $100, though of course that may not be the case, but let's say it is. What would the closing price of IBM be tomorrow? Well, it's very, very unlikely that it'll be a number significantly different from 100. Think about the things that can actually cause a big change in asset values, a bankruptcy or a merger. Rare corporate events are, well, rare. So that means for the most part, we should expect the price of IBM tomorrow to be fairly similar to the price of IBM today. So we can make what's sort of a reasonable guess. We can fit some sort of distribution like a bell curve here, where maybe the most likely outcomes would be that IBM pretty much stays around 100, and there is a decreasing likelihood of us making a bigger deviation, either to the downside, where it gets closer to 0, or to the upside, where it gets closer to doubling price. Remember, if we're thinking about stocks, the sort of range of this random variable, the price of the stock, would be bounded on 0 to infinity, because technically a stock can be worth any non-negative number. Remember, it's not negative because of that limited liability provision that we talked about for public companies. In other words, you can't lose more money than you put in, so the equity in a public company is bounded on the low end at 0. And the range of a stock return, then, if the price goes from 0 to infinity, the return can be as low as -100. In other words, you lose everything, you get wiped out down to 0, and up to also positive infinity. So these are sort of the intervals over which we may want to build probability distributions, either for a stock, either for a return or for a price. Now, how do we actually define this distribution? Well, we can look at historical data. In other words, we can see how volatile IBM has been in the past. We can see how often it made a big price movement of 10%, 20%, how often it actually got either close to 0 or to doubling its price. That'll help us fill in that bell curve or any other curve that we try to characterize the return distribution with. And then we can also look at what's been going on with similar firms. In other words, if we're talking about IBM, maybe we can think of other tech firms. And then, of course, we can also see how the economy has behaved, because we can perhaps view the tech sector as a certain part of the national economy. So we can look at how GDP varies, and therefore how the tech sector's productivity varies as a subset of GDP, and then how the value of IBM varies as a subset of that tech sector. So there's actually a lot that we can consider about economic conditions, including things like interest rates that'll help us set the discount rate for cash flows. But at bottom, there's really sort of two characteristics that we really want to hone in on. The first is the expected return. In other words, what we might expect the price change to be at some period ahead, and the variability in this return, some deviation from the mean. So let's think about these intuitively, and why it is that investors really should care about these primarily. And so for the purposes of this discussion, we'll say that the mean is a measure of the expected future return, and the standard deviation will be the measure of risk, and these will sort of be the characteristics of the distribution of asset returns that we'll think of. So let's look at two examples of candidate return distributions. Distribution A has a mean of 5%. In other words, its sort of central value, the most likely value in the distribution, is positive 5%. In other words, the most likely outcome you'll see from the distribution of this asset returns is a gain of 5%. And the other thing that we can see by looking at the distribution function is that it's relatively tightly bound. At least for distribution A, it's more tightly bound relative to distribution B. If you notice, distribution B has the same mean. In other words, whatever asset distribution B describes will also, in expectation, get you a 5% return. But it could be substantially more or substantially less than asset A. So one thing that we may ask ourselves, and one thing that's critical to an investment process to ask, is which distribution is actually the better investment? I mean, they do have the same mean, but this is where the importance of that second characteristic, the spread, comes in. But generally, it sort of depends on the investor. So for example, a risk-seeking investor, somebody who actually likes wild swings, crazy gambles, and it's not unimaginable that there would be such people, who goes to casinos, for example. If somebody likes to win big and is okay with losing big, well, they would probably prefer asset B, because it does offer you a fair chance, indeed, of a greater payoff versus a greater loss compared with asset A. Whereas maybe your more typical investor would be someone who just likes a payoff with less risk around it. So that person may prefer asset A, because at least if our choice is between A and B, asset A offers you the same payoff with far less uncertainty about it. And then a risk-neutral investor. And remember, when we talked about the expectation hypothesis, we assumed a risk-neutral investor. And this isn't a too uncommon assumption because, for example, a large financial institution may not really care about risk one way or another. They really do just want the highest expected return for their investors. So a risk-neutral investor would actually perhaps be indifferent between A and B, simply because both assets do offer the same expected return, even though there are differences in risk. Now, what if we shift the distributions a bit? Let's say that asset A actually has a different mean from asset B, which is not unimaginable, right? A distribution can have both a different mean and a different spread than another distribution. So let's say asset A has a higher expected return of 8% than asset B, which is still at 5. And of course, asset A still has the tighter spread also. Well, still, we can't necessarily say that it's for sure that there's never going to be anybody who will ever take asset B over asset A, because you can still see that there is some chance that asset B will give you a higher payoff than asset A, even though now there's comparatively a much higher chance that asset B will give you a lower payoff. So we can imagine someone who is sufficiently risk-seeking that they would still prefer asset B, but we are more certain that more risk-averse investors, or even less ones who are somewhat risk-seeking but not outrageously so, more investors will now prefer asset A. So that's sort of the intuition behind return distributions and why we care really about these two characteristics, the expected return, the mean, and the spread, the variability of the assets outcomes. But, you know, these distributions are sort of difficult to conceptualize. You can draw them, but you can't do much mathematically with them unless you assume some continuous function. So rather than doing that, a good enough approach, at least good enough in many cases, is to actually represent these continuous distributions across all possible values of returns as an event tree that really just gives you a few probabilities of a few critical outcomes. So how do we conceptualize that? Well, let's think about a stock analyst. And a stock analyst generally makes three types of recommendations, right? Buy recommendation, hold recommendation, or sell recommendation. And really that may mean that we can get away with transforming this extensive continuous distribution of this random variable, the stock return, into really just a tree with three possible outcomes: a good one, a middling one, and a bad one. And let's say that the way that we sort of parse these is that we'll say anything that's 5% or greater is going to be the good outcome in terms of expected returns. So that would be a buy recommendation. Anything between 5% and negative 5%, or maybe some region in between those, maybe 2.5% to negative 2.5. That'd be sort of the middling outcome, and anything worse than that would be the bad outcome. So with that, we can actually sort of break up this continuous distribution into three possible outcomes. Let's say that there's a 25% chance of the bad one, a 25% chance of the good one, a 50% chance of the middling one. And now you see that we were actually able to represent this continuous probability density function, which, remember, probabilities must sum to 1. Well, these three probabilities do. They add up to 1, and they give you the chances of any of these three outcomes that we have defined as sort of spanning the list of possibilities. So let's actually see what this would actually give us for an expected return. Well, if there's a 25% chance of the good outcome, which is 5% return on average, and a 25% chance of the bad outcome, negative 5% on average, well, those two cancel each other out, right? And then all that remains is a 50% chance of the middling outcome, which is 0. So given this tree representation of the probability distribution, we would then make the recommendation of a hold because our expected return is 0. Now, this may sound awful simplistic, and in a way it is, but this is actually the sort of underlying principle for some very complex analytical methods. So how can we make this a bit more sophisticated? Well, one way that we can is by acknowledging that really maybe this single period tree is really only good for very short time intervals in the future. And one way that we can make this approach more nuanced, as we'll see in just a little bit, is we can actually stack these trees one on top of the other to span more different outcomes farther out in the future. So rather than maybe the expected return tomorrow, we can describe the expected return a month down the road by essentially drawing a lattice of these trees. We'll see about that in just a little bit. But let's say that we wanted to incorporate some macroeconomic conditions into this model. So let's say that we're going to have a probability of the stock going up in price be 2/3, and the probability of stock going down in price being 1/3, maybe because we've calibrated a model of macroeconomic growth and realized that generally growth states occur more often than recession states. And so then what we can say is we would need to map returns to these states as well. So let's say that in the growth state, which occurs 2/3 of the time, we are going to observe a 10% gain. And in the recession state, which occurs 1/3 of the time, we're going to observe a 10% loss. Well, in that case, we can then take these probabilities and state contingent returns, and from them compute state contingent values of the stock, right? So if 2/3 of the time you gain 10%, what would the stock's value be? Well, it would essentially be 1.1, 1 plus 10% of its original value of 50, or 55. And 1/3 of the time you would lose 10% of your value. So that would be 1 minus 10% times the original value of 50, or 45. So what then is the expected value, the mean, of this stock? Well, we simply take 2/3 of 55, 1/3 of 45, and we see, of course, that this is going to be a value that is greater than the baseline of 50. So this stock has a positive expected return, and so we may actually consider buying, assuming it meets our expected return and other criteria. But at the very least, there's a higher chance of making a profit than making a loss.